Think about this. Every time you scroll on your phone, buy groceries, or fill up your tank, you're handing your money over to a massive company. But what if you were on the other side of that transaction? What if you were the one getting paid? That is exactly what happens when you own a stock. Essentially, the stock market is just a giant marketplace. It's where you can buy and sell tiny pieces of ownership in the companies you already know and use. We call those pieces shares. Now, why do these companies let us in on the action? Well, they need to grow. Instead of going into debt with a bank, they'd rather sell a small percentage of the company to the public to raise cash for a new product or to open a new location. It's a trade. They get the cash and you get a seat at the table. As an investor, you usually win in two ways. First, there's capital appreciation. That's just a fancy way of saying the company grew, became more valuable, and now your share is worth more than what you paid for it. The second way is through dividends. Think of this as a thank you check. When a company makes a profit, they sometimes take a portion of that cash and send it directly to you. Now, stock prices aren't random. They're driven by us. It's all supply and demand. If a company is doing great things and everyone wants in, the price goes up. If the hype dies down and people start selling, the price drops. But let's be real, investing involves risk. There are no guarantees. If a company fails or the market shifts, you can lose money. That's why it's a marathon, not a sprint. Ultimately, the goal of the stock market is to give you a chance to participate in the growth of the global economy over the long term. It's about building your future, while the world's biggest companies do the work. That's the stock market explained, straightforward and simple. If this was helpful, like the video and subscribe, and let's keep building your financial foundation together.